Hi, everyone, and welcome to our first quarter, January 2026 outlook, a little bit of a review of what happened last year, and a little bit of what do we think is coming for 2026. So, Kristian, welcome back. Nice to see you.
Great to be back with you in full force, Darren.
Fantastic. I hope you had a nice Christmas. I'm actually going to be using my one of my Christmas gifts. So, guess which one of my children gave me this, and why did you pick my daughter? Anyway, moving on. So not much has happened since we come back to work, hey? It's been kind of quiet out there?
Certainly, I guess not much has happened, but in earnest, I think there's been no shortage of questions. And Darren, it seems new ones come up every time we look at our phones.
It does. Although I would anyone that was starting off this year thinking, I'm going to try that dry January thing, good luck with that. You've been challenged like maybe you didn't expect. So why don't we dive right in? I know you got a lot of charts and graphs and things to help, I think, guide the way. And it's nice to see that some of the things that you and I talked about just in the first few days of 2026, we actually been kind of right on guessing how some of these balls would bounce. But I think for those of you watching, please watch right to the end. We have quite a lot of great data and I think some really good insight.
Yeah,
so,
as I just alluded to, there's a lot of questions that need answering. That's why we titled our 2026 outlook here a year of answers, and hopefully we'll be able to answer all of your questions. So first, as is customary, a word from our lawyers. That's not the question we wanted answering to, so we'll move on from that. Let's start first with a look back on what was another strong year for equity markets. We've entered rarefied air, with S&P provided a third consecutive year of double-digit gains, a feat that's only occurred 5 times in history. The AI trade, which rest assured we will discuss in detail, was alive and well and evidenced through the outsized performance of the technology and communication service sectors and tangential sectors such as utilities and industrials. Healthcare, which was one of our preferred sectors going into this time last year, one we still like, finished the year strongly and was the best performing sector in the fourth quarter, up nearly 12%. So, another strong year. And when we spoke this time last year, we highlighted the heightened valuations in the market, but also noted that valuations are not a fantastic predictor of 1 year ahead returns. Instead, we indicated that where valuations were, earnings growth were needed to drive U.S. equity markets forward in the year ahead. That did occur, with earnings growth the predominant driver of returns, as multiples, as we can see on the chart on the left, ended up in a similar place to where we started, which is still quite elevated. And speaking of valuations and drivers of equity market performance, Darren, we'd be remiss to not mention a recurring topic, which is market concentration. Yeah. The Mag 7 continued to drive the bulk of equity market returns in 2025 and now represent an even greater share of the index at 40%, as we can see on the chart on the right.
Now, most Canadians, by the way, that were investing a long time ago are going to probably want to call their therapist after this, because we've been talking about this for a while. That concentration continues to become more concentrated. You know, the graph on the right showing that at the end of December, 40% of the S&P's performance was 10 companies. Canadians will remember this story back in 1998, 1999. Nortel and JDS Uniphase, those two companies became about 50% of the market. So we've kind of seen this movie before, and I'm not trying to have an emotional reaction, but it does cause me to vibrate. So we're very mindful of this, and it makes it very difficult for people that want to manage risk, because the train's going 1,000 miles an hour. But if you want to step off of it or recognize that, again, we've seen this movie before and you start managing against it, you are going to give up some return. But I think that's wise. And, we've always kind of followed this idea that diversification, it's a bit of a trade-off. You don't get to shoot the lights out, but you also don't shoot yourself in the foot. And I think that as we look back over last year's performance, we've done really well. But frankly, the right thing to do, if you just looked at the numbers, was to throw caution to the wind and put all of your money in 10 companies.
Yeah.
Not to predict the future, but I don't think that would work out very well whenever what's going to happen might happen. So we're going to keep managing risk. And I just want everybody to know that this concentration issue, it just keeps getting worse. People keep putting their same coins in the same slot machines. And as you go back and look at that chart from a long time ago, most people, when they grew up investing, I'd say the average, adult investor, most of their investment career was from, call it 1999 through till now. And we haven't really seen anything close to this concentration in the S&P 500. Canada saw it, but nobody else has. So we're really, really mindful of this.
Yeah, and thankfully, since October, we've actually seen a pretty notable divergence. The S&P 493, which is the ex-Mag 7 companies, have actually begun to perform relatively better than the Mag 7. So some of the broadening that we've really been hoping for as of late is beginning to come to fruition. And the story for us really remains the same. The concentration is there, and we continue to view many of the Mag 7 as fantastic businesses. And we can see that they've actually been supported by relative earnings growth the last 3 years. However, we continue, as you alluded to, Darren, find value in the S&P 493, and we remain principled to not be overexposed to any one theme. And so the broadening that we've seen as of late in U.S. markets is one that we actually began far earlier in the year with international markets, and this is good news for investors. Most ex-U.S. markets performed exceptionally well last year, and we've highlighted in our quarterlies some of the drivers for this change in perception and momentum. U.S. dollar weakness following years of appreciation contributed to an even greater return for U.S. investors with a globally diversified portfolio. Canada is what I would classify as a notable standout, especially what's been a persistently weak economic backdrop. The TSX returned nearly 31% last year. 2/3 of that return can be attributed to the materials and financial sectors, which caught a very significant bid. Materials, of course, encompasses precious metals such as gold and silver, which saw renewed investor appetite as a hedge against U.S. dollar and equity market volatility. Financials benefited from strong earnings growth attributed to improved capital markets activity, which drove non-interest income, stable loan provision levels, and some multiple expansion. So overall, on balance, from a global picture, it's been a very good year. And so,
yeah. No, by the way, before we go on, what I will say there is in our models, we've always owned Canadian bank stocks because, as Butch Cassidy and Sundance Kid once said, that because you rob a bank because they have all the money. It has been a bit of a bumpy ride, though, Canadian banks. I think one of the reasons that they had great performance in the last year or so was just kind of coming back off the mat. We had a little bit of a crummy ride there for a bit. So it's just, I think, kind of we went down. Now we've come back up, and this part of the curve catches the up part. But with respect to gold, we really don't have much of an allocation to gold, even though it's basically doubled this year. And I've done a video in the past on why we're not gold bugs, and it's because I'm not a pirate. And gold tends to only go when people are freaked out. And so not that there's been anything to freak out about, but that's one that we just frankly don't really have much allocation to and just strategically don't. And I don't think we're going to. So we kind of missed the gold thing, but that was a little on purpose. But we did catch the financials.
Yeah,
for sure.
we have some exposure in selective portfolios, but we use it as a small amount. And certainly in a future video, we'll go dive into why some of the traditional drivers of gold have really not been the reason for its recent appreciation. And so now I've titled our next slide here 4P. So are we going to have a fourth consecutive year of exceptional gains in U.S. equity markets? One thing that we would turn on here is that just to convey our thoughts, we're cautiously optimistic on equity markets for the forthcoming year. Strategists are universally positive and sentiment has rebounded sharply. The average predicted return for the year sits at around 11%. Now, we don't partake in the dartboard exercise of publishing exact price targets, but if we did, we'd likely lean towards the right half of this distribution on the chart on the left. And there are several reasons for why we would expect solid but more muted returns in 2026. And that brings us full circle to the title of our outlook today, A Year of Answers. And to start, there is no bigger question that requires answering than the state of AI and if this bubble is going to burst in the next year. Now, you've likely heard the term K-shaped economy, and that refers to the shape of a K and the bifurcated nature of the U.S. consumer. But it's also been a story of fixed investment, with much of the U.S. manufacturing, industrial, and housing picture remaining weak throughout the year. And despite that weakness, AI investment has been a shining star and material contributor to GDP growth, as we can see on the green line on the chart presented. Most estimates have AI investment contributing over 0.5 to 1% to real GDP over the past year. So the effects of AI on the economy are visible and tangible, but is this party ending? Now, one of the key factors that we are keeping a close eye on for this train to keep chugging is the anticipated adoption of AI across the economy. As we can see across these charts, AI adoption and penetration across the real economy remains quite low, but the rate of and the intention of adoption continues to trend higher. Now, if the actual rate of adoption begins to materially trend in the wrong direction, this would signal to us that the belief for AI is collapsing, and so too it will the stocks tied to the demand for AI. A deceleration in adoption rates is a phenomenon that we saw in the early 2000s as a dot-com bubble burst, but notably we're not seeing those same conditions yet.
Now, I do want to draw we have talked in the past about using Cisco's stock price as an example of what happens when everybody gets excited about the wrong thing, or they get excited about the big picture, but they buy the wrong stuff and they don't pay attention to price. So back when we're in the late 90s, we're getting the internet, everybody's getting excited about it. People ran out and bought, call it the routers, the stuff that built the internet superhighway, the information superhighway. And Cisco is the most emblematic of that. And what was really the best value wasn't the guys that built the highway, it was who benefited from the highway. So we had businesses like Amazon or Netflix and things that have come out of, I wouldn't say nowhere, but certainly were not the obvious. Actually, many of those companies didn't even exist in 1999. There was no Uber, for example, back then. But really, it's the beneficiaries of the technology we're trying to find. And I think today we're seeing a huge amount of investor interest in the back to the chips and routers kind of thing, which is, the NVIDIAs, the people building the AI. To us, the real long-term wealth creation is going to come from who's able to utilize it. And that's what we're trying to focus on.
Yeah, exactly that, Darren. We're doing a tremendous amount of work to see who will be the ultimate beneficiaries of AI. And a lot of that's not yet known, but that's why we're doing so much work behind the scenes to figure that out, hopefully ahead of many others.
Yeah, and what we have to be mindful of is there's a lot of CEOs now, for example, coming out saying, we're not entirely sure that all this money is going to do anything yet. We don't really know how to use this facility. So a lot of investor excitement with something, but how it's going to be used, where it's going to add value, not crystal clear by any means yet.
Yeah, and we have a few charts on that towards the end of our presentation here on AI that really touches on how it's being adopted, how it's affecting the economy so far. And before we get to that, so we just talked about adoption looking quite okay and still strong demand for AI. Well, CapEx intentions from hyperscalers continues to increase at a rapid pace. Certainly, this does lead to the greater possibility, Darren, of some of that overcapacity you mentioned from excess spending, especially with the limited visibility we've had so far on return on investment. However, from the chart on the right here, we can see that this CapEx is really largely self-funded, driven from operating cash flows, which are also increasing at a rapid pace. This means that the contagion from overcapacity can be fairly self-contained to these hyperscalers who currently have the ability to spend. And speaking of estimates, they've actually undershot actual spending by a significant margin the last 2 years. So TSMC, Taiwan Semiconductor, the world's largest contracted chip maker and a key player in the AI value chain, recently released its latest quarterly results. In it, management highlighted stepped up CapEx in Taiwan and the US to add production capacity to meet ongoing and increasing demand for AI-enabled chips. So CapEx spending appears healthy, and by all available metrics, it's set to continue to accelerate in the coming quarters. This should continue to act as a boost to the U.S. economy. Another area that we want to highlight, Darren, and you mentioned it with some of the analogies to the late 90s, is valuations. What is apparent to us is that the businesses now are healthier and more profitable than those in the late 90s. So as evidenced on the chart on the right, 7 of the largest AI exposed companies, that would be NVIDIA, Apple, Microsoft, Amazon, Meta, Broadcom, and Google, have all seen accelerating earnings alongside stock price appreciation. This is a much healthier environment than that of the dot-com bubble, when the largest and best performing companies of that period, think of Microsoft, Cisco, which you mentioned, Darren, Intel, and Dell, experienced sharp divergences in price and earnings growth. And speaking of that tech bubble, it would seem odd to us if the AI bubble crashed and burned after only 18 months, a particularly short time when compared to history. The CapEx story for the internet lasted a decade, and in examining similar periods of excess CapEx, there are very few that lasted just over a year. So there are a number of metrics that say to us that we aren't there yet, and this bubble has room to inflate further. But like almost every other prior CapEx cycle in history, inevitably this too will eventually end in tears. And while, Darren, you alluded to it, we could have used the late 90s and the internet bubble, the most commonly cited example, there are several other instances through history that tell a similar story. You have the electrification boom of the late 1920s. You have the various oil boom and bust throughout history, whether it's the Iranian oil crisis that preceded the 1985 crash from oversupply, or the 2015 crash from the boom in U.S. shale. Here, we decided to go even further back and show the railway boom of the 19th century. As with other CapEx cycles, we see that the bubble eventually bursts. And while the foundation and technology laid is great in the years to come for the rest of the economy, those few and concentrated stocks that were the largest beneficiaries on the way up are inevitably the hardest hit on the way down.
Yeah, and we could also put a more recent example in, which would be cannabis, for example. So this is a pattern we see repeatedly through time, and you know, what's that joke about? The only thing people learn from history is they don't learn from history. So we are paying attention to history. You're right on that previous chart to show that the foundation today for the AA stocks is economically a lot healthier than the nonsense that we saw back in the late 90s. And I was around for that. And it was very hard to try and convince people that most of that was vapor. There really wasn't anything underneath it. Some clients listened. A lot of were mad at me when I wouldn't let them play or didn't want them to play. A year later, I'm the smartest guy they ever met. But that was a lot easier to call out that the valuations were ridiculous. Today, it's not so much that the valuations themselves are ridiculous compared to earnings. It's really we're being mindful of this story will repeat itself in some way. And as Mark Twain says, history doesn't repeat itself, but it sure does rhyme. Mm-hmm. So we're riding, and as in our portfolios, we're riding some of that AI thing. We're not getting overly excited and putting all of the money on those chips. But we're very mindful of the better and longer term, bigger opportunities will be connected to AI. So we're widening our horizons out.
Exactly that, Darren. And the whole point of this discussion here is to say, we're keeping our eyes open, which is a title of our next slide here, because we need to be aware of the risks to be able to change when the conditions change. And part of that change, as we see in the chart on the right here, is that the peak in stocks in the last few cycles narrowly preceded the peak in CapEx and construction activity. So having visibility in the direction of CapEx and the earnings that support that CapEx, which we just spoke to, is critical. So as you just said, Darren, we know this is going to end poorly at some point. The biggest question is when and what are the signs, and we just spoke to one, which is the declining rate in relative CapEx growth. Another consistent late cycle indicator has been a shift from internally funded CapEx to debt-driven expansion. Rising leverage had made these systems in the past more fragile, increased contagion of any failure to the rest of the economy, and has amplified subsequent corrections. And as we touched on earlier, so far, debt is fairly well contained. The majority of spend from hyperscalers, which make up about 50% of data center spend, has been from internally generated free cash flow. We are, though, starting to see a slight change based on the chart on the right, with private credit AI finance deal count beginning to increase. However, we're not at debt levels yet that indicate immediate concern. This is one area that we're going to continue to watch closely, especially with the news of continued private credit involvement, off-balance sheet financing arrangements, and circular financing. Well, what else could throw AI off its horse? Well, there are some key bottlenecks across the industry, which does show demand is greater than supply. And one of the most critical is the lack of power supply. As we see on the chart on the right here, data centers are making up an increasingly large share of global electricity consumption, and this could triple by decade's end. Based on current projections, rising demand for AI and increasing compute intensity are translating directly into higher consumption, and this is demand that cannot be currently met. We're also seeing rising demand cause a sharp jump in electricity prices in key areas such as those in New England, the Pacific, and Mid-Atlantic. And so more innovative solutions such as small modular reactors will matter in the 2030s, but the electrical grid capacity remains the key bottleneck in the near term. And this has actually become a key administrative priority for the Trump administration, and one that likely requires the use of traditional energy sources to bridge the gap until more durable solutions arrive. So for now, nevertheless, energy capacity is going to be a key constraint into the pace of the AI build-out. And so this brings us to our last point. Is AI real? Because again, as you said, Darren, ultimately, for all the spending we are seeing to be justified, AI needs to provide a material thrust to overall productivity and the economy. Now, productivity is notoriously difficult to estimate in real time, but we haven't yet seen the surge from AI that we did in the early 2000s from the internet tech boom. However, recent third quarter data does show productivity is accelerating. And for every study that indicates that job prospects have worsened, most in sectors that are vulnerable to AI, there's a study showing no disproportionate impact on AI-exposed sectors. So beyond its impact so far on some very specific occupations, such as software programmers, as we see on the chart on the right, it's a
or designers, given that some of the great graphics you've used for this have been AI. We didn't have to hire anyone to paint them. Right,
exactly
or to draw them.
Exactly that. So its effect is so far probably much more limited than is currently being made out. A recent study by the Budget Lab at Yale showed that occupations with the highest U.S. unemployment increases are a mix of those with both the most exposure to AI and the lowest exposure to AI. So not really a definitive conclusion. It's also important to recognize we're in a pretty soft labor market, which could be overstating some displacement from AI. So back to our original question on this slide, is AI real? Unfortunately, this isn't a question we can't quite answer yet. It's possible that the productivity benefits from AI are more moderate than what we saw from the internet, and that would likely bode poorly for AI stocks. However, new AI applications continue to arise daily, and we continue to monitor their effectiveness to discern their economic impact. And no, this doesn't include my tastefully selected pictures throughout our presentation or some AI videos of Spider-Man running around New York City, as awesome as they look.
Or my Bigfoot ones, the Stormtroopers. I'm a big fan of those too.
They are
amazing stuff.
Yeah. So, but ultimately, as our point said earlier, the best adopters of AI will likely be the largest winners in the year to come, and we are being very aware of what those could be. So that is our review of AI and the AI bubble. And just as a quick summary, our endpoint is we're not quite there yet, but we are very aware of the risks as they continue to percolate. The next area that we wanted to address for questions for this year, and I've titled it A Fractured World. So as the title suggests, we are in a new geopolitical paradigm. It is one that Prime Minister Carney spoke to in his recent address in Davos. And now, if you don't want to take his word for it, the World Economic Forum publishes an annual report that analyzes global risks from serving thousands across academia, business, government, international organizations, etc. In this report, most respondents highlighted that the world is becoming multipolar, dictated by great powers, middle powers, and regional spheres of influence. This has significant effects when we think about global economic and political uncertainty, which will only be heightened in the years to come. We are only 3 weeks into the year, but Trump's recent comments on Greenland, the capture of Venezuelan President Maduro, local uprising in Iran, all reinforce this view of continued geopolitical volatility. And when we think of competing powers, it's important to not let China and the US's recent truce with them fool you. China remains the largest global threat to the US's place as the global economic leader. And while a temporary detente was necessary given the US's reliance on China's rare earth minerals, for which they import over 70% of its inventory from, don't be so certain that tensions between China and the U.S. will not continue to flare in the year ahead.
Yeah. Although I will say with the Greenland thing, now that it seemed to panic people that, oh, maybe they're going to go to war with China and Canada's going to send, I don't know, a hockey team or something to Greenland to help defend it. We have talked about this in the past. I think you've got another chart coming up. I am shocked at how people have apparently never read The Art of the Deal. Like, this to us was so on point with how Trump has told people for the better part of 40 years, this is how I negotiate. This is how I make deals. And I can't believe that people thought we might go to war over Greenland when to me, it's just typical of his negotiation strategy. And you don't have to like it. You just have to acknowledge that that's what he does.
Yeah.
And we don't yet know what the deal looks like, but it looks like he may have gotten what he wanted without having to send a single U.S. military member there. So we try to just play it up the middle and don't get too agitated about it.
Yeah, we published, following the tariff announcements in April, we published a framework for dealing with Trump's negotiation style, and it's predicated on his heart of the deal. But in just, when he first throws things out of the crib and breaks things, it's important not to have an emotional reaction to that, because in the end, he does moderate his view and you'll end up reaching a fairly reasonable conclusion. So it's important to remove some of the emotion from it, because a lot of what he says and a lot of the rhetoric that comes out on his Truth Social is just that. It's rhetoric and really not action. So we do have some more points on that later on.
I think we've done a good. Sorry to interrupt. I think we've done a good job as a team of regularly inoculating ourselves from TDS. We try not to get too concerned about it. Exactly. It's hard. It's hard, but we try not to.
We try our best. So, what better way for us to look at this fractured world than through a quick summary of where every major country or region stands? And when I say major, obviously that's doing a lot of heavy lifting for Canada, but we're Canadians, so I've included it anyways. The gist of it is that monetary policy is unlikely to be a significant driver of the major developed economies this year, with most cutting cycles complete or nearing completion. Instead, we can focus on the relative fiscal pictures. In Canada, we have the third largest fiscal thrust in 2026, courtesy of the newly announced fiscal package, which we are going to review in detail towards the end. In the U.S., ongoing tax reform and deregulation should be fairly supportive. One of the key reasons we became more positive on Europe in the first quarter of 2025 was the fallout of the German elections and resulting infrastructure and defense package. This, coupled with increasing requirements for NATO defense spending, should entail continued fiscal outlays. In Asia, China's economy remains a mixed bag, but they too continue to try and reorient their economy to support domestic consumption. In Japan, rates are beginning to trend upward from an accommodative stance, and the newly elected prime minister pushed through a substantial fiscal package in the fall of last year following her election. So we also see several initiatives in Asian markets that are ongoing to support capital markets activity via corporate reform. So on balance, when we take across these four geographies in the world, fiscal dominance seems to be alive and well. And before we dive into the US and Canada, let's talk about international equities. as we just said, the fiscal picture seems supportive, and we're now finally seeing improvements in fundamentals. After years of mundane earnings growth, consensus expectations point to an improved fundamental picture in the year ahead. With narrowing relative earnings growth expectations and stimulus arriving in key countries such as Germany, our view is that the broadening of equity market performance will continue to spill over to the rest of the world. We also view select international exposure as a nice diversifier to the tech-heavy US dollar-denominated S&P 500. So with all that said, like with all of our investment conclusions, we sleep with one eye open. Not lost on us is the fact that Europe remains a fragmented picture with benign expectations for economic growth. France, for instance, which makes up about 15% of Eurozone GDP, continues to exhibit poor growth and an unsustainable fiscal picture, coupled with a political landscape that remains deadlocked. Even in Germany, economic sentiment is weak and consumer spending has been slow to recover. China is mired by their own domestic issues, and they're posing a continuing threat to Europe and other economies given the changing nature of their export composition. So China is now producing higher value items such as automobiles, which represent a key significant competitive threat to European exporters. And lastly, demographics remain a key structural issue for several of the countries that we just mentioned. So to conclude on our brief trip around the world, there are certainly several improvements in the European and ex-US landscape, but it's important to remain vigilant as headwinds do remain. Still, we do see continued benefit from international exposure and believe it can act as a good diversifier to U.S. equity exposure. We just aren't there yet to significantly overweight international equities.
Yeah, we were a bit early, I think, last year or the year before to start beginning to diversify a little bit away from the U.S. to international. I think we've caught some of those trends really, really nicely. But you're right. There's no flashing green light that says do a huge shift over.
Yeah, exactly that. And so let's get to U.S. policy.
I don't know how you did these things. I'm amazed, but these are great graphics you found.
I was as shocked as you, trust me. So
I was using ChatGPT for birthday cards. This is incredible.
So let's not forget about the many questions we have to answer around U.S. policy, courtesy of Mr. Trump here.
Are you sure his hands are that big? I'm not positive. But anyway.
Don't ask him,
moving
please.
On. Don't ask him. Oh, yeah, of course. They're bigly.
So there seems to be no bigger story, of course, than tariffs, and is one that seems to never go away. And certainly it's not going to be leaving us anytime soon. Ultimately, we've landed at a level well below that fateful day in April when Trump stepped out on the Rose Garden. Still, we remain well above historical levels, and tariffs do continue to impact economies and markets. As we see on the chart on the right, dissipating trade uncertainty, as Trump has scaled back some of his rhetoric and began to sign deals, has been tightly correlated to the sharp increase in U.S. equity markets. But the question that we all want to know is where do we go from here? Well, one thing we do know is that trade policy uncertainty, while it has recovered, will remain elevated. The best example of this, and we just spoke to it, is the dealings with Greenland and Trump's use of tariffs as blackmail against European countries. We also know that goods continue to be rerouted from high tariff economies such as China through other ports such as Mexico, and this could be a very significant point of contestation in the upcoming CUSMA renegotiation. And to top that all off, we have an upcoming and much anticipated Supreme Court ruling on the legality of Trump's use of tariffs that will have significant implications. Now, it's important to note there's other avenues for Trump to impose tariffs through his sectoral Section 232 tariffs or country-specific tariffs such as Section 122 or 301. But this will add even more uncertainty to the trade discussion. So that's the story on trade. It's better than it was, but still in motion and ever changing. And as we said countless times, uncertainty really isn't a friend of the markets.
But it's been a friend to us in the sense that, just to remind people, and I know Nick and Pedro, when they've been doing their reviews for everybody, have been really good at pointing out that when Trump stood up there with his signs on Liberation Day back in a little about a year ago this time, a little more than that, markets dropped like crazy right after that. No one knew what to do. And our portfolios went down a bit, but only a fraction, because we've got such good risk management built into what we do. And because we stay diversified, we only went down a fraction of what our markets did in the chaos of that. And I think because we read the art of the deal and we understand that Trump, the way he negotiates, and he was using tariffs as a weapon to negotiate, we didn't get too fussed about it. So while other people were running for the hills, we actually stepped in and deployed capital in the middle of that. And our returns have benefited by, the oldest rule of investing, buy low, right? So we did. And so we look at some of the turmoil and chaos that Trump might generate and tariffs and things might generate. We see those as, every once in a while we get some opportunities because of that. So we kept our wits about us. And 2025, we certainly benefited from the kind of noise and things that happened, and our response to it, I think, was really smart and business-like, and we took advantage of that.
Exactly.
And if we get another one, we'll do the same thing again.
Yep. And I have a chart at the end on volatility. So I think maybe we stole a little bit of our thunder there, but it speaks to the point that you just mentioned there, is that volatility for us is a time of opportunity.
Yeah.
So that is the story on trade. Well, what about the stimulus that we alluded to just a little bit earlier? Well, it's coming in the form of larger tax refunds from retroactive individual tax cuts in the One Big Beautiful Bill since the start of 2025. The majority of these benefits are expected to manifest at tax filing time early this year, so around April, May, and June, leading to reduced final tax bills or increased refunds. Now, this temporary boost will partially aid lower income households' discretionary spending because they have a higher marginal propensity to consume, meaning they spend more of the income that they get. But a good chunk of it is going towards higher income households because of the federal increase in state and local tax deduction. Now, disproportionate wealth increases to this upper income bracket is not a new phenomenon. As we see on the chart here on the far left, wealth disparity in the U.S. continues to grow, and that forms the second K, as we so called it earlier. However, middle-income consumers, so that's the chart in the middle here with the big box around it, continue to collectively represent the majority of the consumption picture. The One Big Beautiful also contains favorable provisions for corporations, including bonus depreciation and R&D expenditure. That should help some non-AI related capex. And so when we think of some of the stimulus that is coming down the road in the year ahead, we'd be remiss not to mention debt sustainability. Oddly enough, as we see on the chart on the right, Trump's tariffs have done well to offset some of the more stimulative measures of the One Big Beautiful Bill, meaning that the U.S.'s net fiscal impulse is fairly benign. A recent study by the Kiel Institute indicated that 96% of tariffs are being borne by American businesses and consumers. So as you and I like to call it, Darren, it's just another form of taxation.
It's a big, yeah. And that's one of the things that Trump's been able to do from a positioning thing, is he makes it sound like it's other people will pay the bill. But anyone who's spent any time in an economics class knows that tariffs hit the people that live there. They actually are harmful to the people that pay it, or the people that have higher prices on everything. So it's interesting that Trump has positioned tariffs as something that someone else is going to pay, but it isn't. It really is an implicit tax on Americans. And frankly, they kind of needed a way to start paying some of their bills. So if this is the way it gets done, this is the way it gets done.
Exactly that. So while the fiscal picture presently looks okay, this could change quickly if tariffs are struck down and not reinstated in full via other means. And in this scenario, we would expect long-run rates to rise as a reflection over very significant fiscal concerns.
Because there is no free lunch.
Exactly that. And so, as if there wasn't already enough happening, 2026 is also a midterm election year. That means all 435 congressional seats and 1/3 of Senate seats are up for grabs in November. This could shift the balance of power, which is currently monopolized by the Republicans, who control all three major branches of government. So what's top of mind for the Trump administration for this election year? Well, one is certainly lower rates. And the real reason for that is to incentivize borrowing and allow people to re-leverage their homes to fuel consumption. So when we spoke just a little bit ago about those middle income consumers, if labor's not supportive, which we're going to get to, and they're not the primary beneficiary of tax refunds, lower rates and an ability to capture some of the appreciation they've had in their home equity is going to be key to support their consumption. We've already seen some action on this front with the administration's recent $200 billion purchase of mortgage-backed securities. The other part of the equation is affordability. So as we can see on the chart on the right, opinion polling on Trump's tariff policy and affordability via inflation has been in a downtrend since his election. This is why recent statements like capping interest rates on credit cards, which frankly have a low probability of success, or
well, no one will get a credit card if they do that. That's the
oh, exactly that.
If they want to do it, good luck getting a credit card.
Yeah, exactly that. It's also included comments such as removing institutional buying of single-family homes. And so we also think that because of the heightened scrutiny around affordability and the poor perception of his trade policy by Americans, this may cap Trump's ability to enact further real damage on the trade front in the upcoming election year. So we've covered a few of the large structural themes in the year ahead. Let's now take a closer look at the health of the U.S. economy. Now, inflation seems to be well contained at this time. And while goods inside inflation has ticked up because of those tariffs, there are other leading metrics within the PCE basket, such as unit labor costs and new tenant rent index, that suggest that a reacceleration in inflation is not a present threat. As such, inflation is likely to remain somewhat sticky and slightly above target, around 3%. On the labor front, the story of a gradually slowing U.S. labor market remains. We continue to be in a no hiring, no firing environment. As a result, we've seen some increase in layoffs and a slight rise in unemployment rate, which may be helped by immigration policy, but nothing to this point that points to a severe deterioration.
Yeah, and if you look at those charts on the left story, we're just kind of going back to long-term trend.
Yeah.
Like there's nothing abnormal. We're not at a high or low. We're kind of just trending back towards, call it normality, if you will.
Yeah, exactly. And there was certainly some excess in hiring coming out of COVID. So some of that could certainly be worked off. And some of that continued softening that we've alluded to of occurring over the last few months, it does appear likely in the quarters ahead based on more advanced job openings data on the chart on the right. And the Fed has stepped in to cut rates to support their employment side of their mandate. And so speaking of the Fed, rate cuts recommenced in September of last year. The Fed is now broadly within range of neutral, with most market participants expecting 1 to 2 additional cuts towards the middle to later ends of this year. Now, the Fed continues to assess the impact of existing cuts and the progression of this labor market. That's why they're currently kind of in a wait and hold approach. And what about Fed independence? Because that also comes up quite frequently. Well, Trump can call for Chair Powell to be fired or rates slash 300 basis points, but the market has given us a clear indication as to the pushback that will follow. As we see here on the chart on the right, term premia, which is the compensation investors require for holding long duration bonds, so that reflects inflation uncertainty as well as economic uncertainty, has spiked when Fed independence has come into question. So a rising 10-year doesn't help with Trump's administrative priority of affordability or a reinvigoration of the U.S. housing sector, because U.S. mortgages are commonly pegged to the 10-year. So his rhetoric around Fed independence is actually achieving the opposite of what he wants to achieve. And it's important for us to also remember that Fed policy is dictated by a majority of the 12 voting members there being the key word. So attempting to replace Chair Powell or fire current Fed governors before their term ends is frankly irresponsible and erodes trust in U.S. markets. The Fed should and hopefully will remain independent, and we should know Trump's pick for the next Fed chair in the coming weeks. So that brings us to the Great White North. And of course, we have our AI image generated for Mr. Carney and our
so much for net zero
in the background.
Yeah.
So going into this time last year, there was frankly little reason to be optimistic on the outlook for the Canadian economy. However, as we've titled the slide, we are now seeing some relative upshoots that have let us become incrementally more positive, and incrementally is the key word there. Darren, we have the trade war to thank for finally inciting some long overdue changes in the Canadian government and its priorities, right?
Well, things like and there's a lot of more work to do, right? We've seen some movement in terms of awakening of spirit of things like interprovincial trade barriers. People have finally, I think, waken up that maybe we should trade with ourselves as an opportunity set, and let's make that easier. Haven't really seen a lot done yet compared to what could be done, but it's positive that we see the wind blowing in that direction. I'd argue that the idea about Canada actually becoming more serious about its defense spending and its ability to be productive is great. I hope the leadership of the DND actually gets it to people on the ground. This is a bit of a joke, but it might be accurate. I think the largest successful deployment of the Canadian military was when Mel Lastman called them to shovel out Toronto 30 odd years ago. But moving on, I think Canada does need, and as we've seen the existential threats to our sovereignty and things, we kind of need to maybe be a little bit better at minding our own capabilities, right? So these are good things, I think, for Canada. I'm sorry, I'm editorializing a little bit, but we're certainly seeing that investment come back, and Canada may be taking a better place on the world stage than it maybe has for the last while. So, I'm still a capitalist, and I try to call it as I see it, though.
Yeah, exactly. And you and I have spoken to a lot of the structural issues facing the Canadian economy, and a lot of these are not going to be fixed quickly, which we have to be frank about. But fiscal support has now arrived, and some of those key measures are aimed at what you mentioned, infrastructure and defense spending, to help revive those areas of the economy. And as we see on the chart on the right, Canada does have room to spend with overall debt sustainability in a reasonable position.
Although I will editorialize a little bit more, I am becoming a bit worried about the quality of data. For example, in the last federal budget, they decided to somehow split the budget between capital and as a financial planner, that doesn't really fly for the individual's budget. So I think some of the bookkeeping, I'm with a few other professionals saying that might be a questionable decision. I'm also worried about things like what's baked in the cake when we look at the net debt to GDP chart that I know a lot of politicians like to tout that, hey, it looks really good compared to G7. But let's remember that a big part of what's in that number is our Canada pension plan that belongs to the people that contributed to it. I don't really personally think that belongs to the government to include in their numbers to try and make it look a bit better. I would like a little more, I'll call it honest and accurate reporting of data. So we kind of look at some of these charts and I think we go a little past face value, and maybe they're not as good as maybe someone wants us to think they are.
Certainly not a perfect picture.
No, I think in terms of Canada's operational capability and productivity and things, there's work to be done on what we spend. There's work to be done on what we get for what we spend.
Yes.
And I just think going forward, Canadians need to be much more serious about where we're going and how we're going to get there.
Yeah,
and I think we have what we've watched in the last year gave us all a wake-up call to why that matters.
Yeah, we got a good slap in the face, and thankfully we actually do have a few charts towards the end of our Canadian slide pack here that reflect some of the changes we haven't seen yet, but really do need to happen to help incentivize that private sector to come back.
Because fancy socks ain't going to get us there.
No, it is not. And before we get to that chart that I just mentioned, similar to Europe, when we look at the economic picture, we're still keeping a close watch for any so-called monsters under the bed that could derail an otherwise incrementally positive fiscal landscape for Canada. And one of those is that we're still not seeing consistent optimism across the economy. Consumer confidence remains muted, and this is translated, as we see in the chart on the left, into weak spending data. Households continue to navigate the tail end of that 5-year mortgage reset that began in 2022 and has otherwise kept a lid on spending. On the business side, we're seeing some pickup in business surveys, which have historically correlated well to GDP. However, this optimism has not been fully matched with other business surveys, such as PMI data. So the picture is still very much murky, and growth is likely to remain weaker than some other developed economies. And importantly, though, the messaging is not as universally downbeat as it was this time year, albeit it was hard to get much worse.
Yeah.
So notably missing from what we just spoke about some of the changes we've seen, it has been the much needed tax reform that's needed to further incentivize business and attract human capital. On a provincial level, such as in Ontario, the top tax brackets have not changed for over a decade, and they've been unindexed from inflation. So as a result of that, the natural effects of inflation have meant that individuals are now being pushed into higher tax brackets without any response from the government. On the corporate side, there's also significant work to do. As we see on the chart on the left, the Canadian economy has an excess weight towards small firms. So 70% of firms in Canada have between 0 to 9 employees versus 50% in the US. This is important because larger firms are a disproportionate contributor to areas such as employment, innovation, and productivity. So why does Canada have so many small firms? Well, we can see on the right here that most firms bunch around the small business deduction limit of $500,000. So before $500,000 in business income, federal tax rates are significantly reduced to around 9%. And above $500,000, income is taxed at 15%, so a 67% increase. And similar increases exist on the provincial level. So, Darren, firms are effectively being disincentivized from growing.
Absolutely.
And the evidence here proves that they're actually adjusting their behavior to not grow further.
Absolutely. And to me, if Canada really wants to be serious about becoming more productive, tax reform is front and center. I don't think you can create a more competitive economy and attract capital to Canada until these are addressed in a material way. And you're exactly right. It's very hard to convince people to come to Canada because when you start making more money, having more economic success, it becomes punitive very, very quickly. Our top tax rate kicks in at about $225,000. That's more like $600,000 in the US. And I just think somebody's got to stand up and say it might be a moral question of should governments be entitled to more than the take-home pay than the worker gets for doing it. Because when marginal tax rates cross 50%, kind of hard to justify that's a competitive idea. And then you're exactly right. I'm glad you found that chart around where, because people tend to follow compensation plans and tax plans. And we haven't seen any increase in the small business tax rate in a long, long time. And so if the small business tax rate tops out at 500,000, surprise, we get lots of businesses that don't do more than 500,000. I would argue, and again, I'm not running for office, but hey, write in a campaign if you want. I actually think if they increased that tenfold and said, well, we'll leave the small business tax rate and we'll raise it to 5 million in revenue, you will suddenly, I bet, see a whole lot of companies suddenly be able to produce a higher degree of growth and opportunity and benefit from that. And I bet you if they did that a decade later, you'd see most of the businesses cluster around $5 million in revenue. And Canada and our people and our tax benefit, everything would benefit dramatically by doing that. So anyway, once again, thank you for attending my TED Talk. These are just Darren's opinions. But I really think tax reform is front and center. And the data, we are where we are because of what we do.
Exactly that. And it's similar to the provincial level. It seems a little bit crazy to me that the last time the small business deduction was increased was 2009. So 17 years of a stagnant small business deduction level that's not indexed to inflation.
And you point out that if we just index that to inflation, it would become probably, I haven't done the math on that, it would probably become $1 million to 2 million plus if we just index it to inflation. And so naturally we get there. I just think that if we want to kickstart things, incentives matter.
Yes.
And you want to create an incentive for people to
grow and do. I think you've got to be able to give them the benefit of that. So I think, again, I'm not running for office, but if I was, these are some things that I would do. So anyway, moving on.
Yeah. And we'd be remiss not to mention, in spite of some renewed optimism we spoke to, the upcoming CUSMA renegotiations. So policy uncertainty has been a key drag on global economies. Canada has been hit hard by such uncertainty, despite faring much better on the tariff front than other developed economies. So we currently have an effective tariff rate of around 5 to 6%, given the current CUSMA exclusions apply to over 85% of our goods across the border. So while export volumes, as we can see on the chart on the left, have come down, we still export 14% of our GDP to the US. So the US remains an important market for Canadian business. Now, it's increasingly difficult to predict President Trump's next tweet, but as we've been saying since the beginning of his presidency, and as we just saw with Greenland, he is quick to go to extreme lengths before reaching a reasonable resolution. As such, we expect headline noise around CUSMA to remain elevated throughout the year until we gain some semblance of clarity. Ultimately, though, we have some reason for cautious optimism at reaching somewhat of a resolution. And as we spoke about previously, affordability is a key concern for the Trump administration. And part of that equation includes keeping energy prices down. As we see on the chart on the right here, Canada continues to contribute a significant amount of crude to the U.S. market. And as much fanfare as there was around the U.S. capture of Maduro, it is likely to take years for Venezuelan oil output to rebound in any meaningful way. Even if Venezuelan oil comes back online in scale, logistical considerations mean that only a small amount of Canadian exports, the 20% that make it all the way down to the Gulf Coast, would be at risk of displacement. Most of Canada's exports only go as far as the Midwest with direct pipeline connection, and most of the pipelines from the Midwest to the Gulf are set up in a southerly direction. So we do have some leverage, but it's important Canada doesn't overplay their hand here, because we've seen Trump is very quick to react negatively to perceived slights and other misgivings, as he so calls them, from world leaders. So we're carefully watching the CUSMA picture. Our key takeaway would be there is some light possibly at the end of the tunnel, but to get to that light, it's going to be a very bumpy and rocky road. So that is our picture on policy and trade. Well, how about the current state of the Canadian economy? Well, the employment picture remains weak, and with some of the headwinds to spending and to trade uncertainty just mentioned, it's translated into weak hiring intentions. This typically leads private employment, so the outlook for employment in Canada remains poor, and similar to the U.S., headline unemployment figures may be slightly flattered by reduced immigration. And if we dig deeper into this employment picture, we can see the tangible effects of tariffs on the economy. Tariff-sensitive sectors like the auto sector in Ontario have been the most adversely impacted, although we're seeing some signs of improvement. And on inflation, with a relatively weak labor market and declining interest rates, inflation in Canada seems relatively well contained within the Bank of Canada's target range. Goods side inflation, similar to the U.S., is picked up due to the tariff environment. But as mentioned, there are other forces that are currently keeping the overall trend level. So with the current economic backdrop, CUSMA uncertainty, and moderating inflation picture close to target, we really don't see much further scope for cuts nor a hike in 2026. This is consistent with the Bank of Canada's recent commentary, which shows they're content with keeping its policy rate at 2.25%, the bottom end of their neutral range estimate. With added clarity now on the rate front, it appears likely for interest rate differentials with the U.S. to tighten further, and this should act as a floor for the Canadian dollar over the near term. This contrasts to last year, when we expected the Bank of Canada to act more aggressively than the Fed to provide monetary easing. So with all that said, hopefully we've gotten to answer a lot of the questions of the upcoming year. And certainly some of those questions we won't have answers to until some of the data comes out. But with all that in mind, we wanted to close here with a final message. And again, it's courtesy a little bit from AI, but it's staying anchored. Now, staying anchored to us means, one, being realistic. If what we discussed today has any resonance, it is that there continues to be a lot of moving parts. while we are optimistic on the year ahead, we don't think it'll be a straight line. We do expect volatility to materialize, especially in the first half of the year as we gain some added clarity on trade, AI, and policy. But Darren, not to age you here, but based on history,
I'm only
intra-year
26. I don't know what you're talking about.
well, intra-year volatility is to be expected, and it's not something should be surprised of. And you've been fortunate to see it through your time in the industry. And as you mentioned earlier, we try to take advantage of it when it does come.
I don't know if I call it fortunate. It is what it is. But you're right. I at least have had the experience now and the perspective. And this is one of the reasons why we often say we don't do panic here. And just to explain this chart, we've used it before, but I think it's helpful to remind everybody. What this shows us that the S&P 500, its average return over that time period is 14%, but it's not an escalator. It doesn't keep going up like that. And to get the benefit of the ride, you had to absorb a lot of bumps along the way. So even though of the last 46 years of this chart, 35 of them finished positive, look at those red dots. You had to live through all those wicked downs and not jump off the ride. So a huge part of what we try to do is manage the risk, try and even out those ups and downs so that the ride's a bit more comfortable. But you can't jump out if it gets bad. You can't get too excited if it's too hot. You have to just recognize it's about staying in the chair as long as you can, staying on the ride as long as you can. So volatility is part of the deal. It's not a feature. It's not a bug. It's a feature. And as I say, we don't do panic here because we've just learned the rules. Stay diversified, buy quality, and don't get scared.
Yep. And speaking of staying in the ride, stay invested. So as you mentioned, Darren, we continue to manage around the risks that we feel can be mitigated, and we're staying true to our principles. So that is to stay invested prudently. To us, this means staying nimble, active, and well-diversified, as you mentioned. If you go back, as you also alluded to earlier in the presentation, there is history of us saying that during periods of volatility, we have to look at that as opportunity. And we might look like geniuses now for deploying capital during that time, but the truth is we did not have to be geniuses. No. We simply had to have conviction in our process and to take advantage of volatility when it's presented. And that reinforces the idea of staying invested. And as we see here on the chart on the right, active management and diversification do not matter until they do. And while we said do not expect the AI bubble to burst yet, we are doing a tremendous amount of work to find unique, idiosyncratic opportunities. And as we discussed today, we continue to feel that there are reasonable opportunities both within the U.S. and outside of the U.S. for diversification. So with that, that is our presentation for today. As we kind of warned you, it's a bit of a long one because there was a lot to get through, but we thank you very much for staying patient with us. And of course, we're here to answer any questions you may have.
Kristian, thank you for putting all those charts and data and those really cool AI graphics together. And for those of you watching this stuck to the end, thank you for doing that. We realize that it is a lot. It's an hour, but it is the beginning of the year and a little bit of a review of last year. So, and this just, I hope, sets the table for how we're looking at the year ahead. So with that, I want to thank you for your trust and partnership. Kristian, thank you for the incredible work you do. Glad you're on the team. And on behalf of all of us on the team, I want to thank you and I want to wish you a wonderful 2026 as we move forward. So thank you.
Fantastic. Thanks, everyone.